changes in federal tax policy and what that could mean for your fundraising and your fundraising planning. Hi, I'm Bill Stanczykiewicz. This is the first day from the fundraising school, and today we're taking a look at the federal tax policies that were signed into law in July of 2025. And the first thing we need to take into account as we think about what these new laws might mean for our fundraising is that the new policies don't take effect until calendar year 2026. Sometimes when the federal government changes tax laws, they say, hey, it's retroactive to this year. That didn't happen this time. So we're looking at what's going to happen in 2026, meaning the tax forms that people file that are due in April of 2027, meaning let's get an understanding now so we can be ready for when these laws take effect. And you'll be doing your fundraising planning leading up to that point. One of the big takeaways with these new policies is this is neither a panacea, everything's wonderful, it's going to open up the floodgates of charitable giving, and it also is not apocalyptic, like this is the end of charitable giving as we know it. Remember, human behavior is very complex. There are many things that affect the decision-making of donors, including those in the business sector, and it's in that complexity that we need to do our planning. The answer is going to be somewhere in between. So as we look at this analysis, some of it will be on research from the college where the fundraising school is located, the Indiana University Lilly Family School of Philanthropy. But I'm also going to encourage you to leaven this with some wisdom based on your own lived experience with your donor relationships, to be thinking about each of those donors, including those in the business sector. So let's take a look then at some of the policies. First of all is the Universal Charitable Deduction, the UCD. The UCD is coming back. It was actually around for quite a while until the UCD was eliminated way back in 1986. But then it came back for a brief time during COVID. What this means is all taxpayers, regardless of their income, regardless of their donation size, can claim a deduction based on their charitable giving. This is important for both philosophical and practical reasons. First of all, philosophical. This democratizes the tax benefits for giving to all taxpayers. It's, the tax benefit for giving now is not just the province of the wealthy. Everybody can get some credit on their taxes for charitable giving. So that's the philosophical reason. Here is the practical. The UCD is worth up to $1,000 for a single filer, $2,000 for people who are married and file jointly. Okay, this actually could increase charitable giving from lower and middle income households if we're asking them, fundraisers. If you listen to this podcast, watch this podcast on a regular basis, we talk about that often. Let's make sure we're inviting everybody. All gifts are important. All donors are important, regardless of donation size. And now with our donors who generously give in that $1,000 to $2,000 range, depending on their filing status, they now can claim a tax benefit starting with their tax forms in 2027 because of their charitable giving in 2026. This very likely, the research shows, this very likely will encourage more charitable giving. And we have some recent history to back that up, not just the research from our school. You all remember COVID era? How could we forget? The UCD had a brief appearance back then. It was $300 for the individual filer and $600 for those who are married filing jointly. And we saw a huge surge in individual donations and people claiming the UCD. So the hope is that that will happen again. As fundraisers, you need to be notifying your donors that the UCD is back and everybody can claim a tax deduction for their charitable giving at those different levels, $1,000 for singles, $2,000 for married filing jointly. Now, things are a little more complicated, and maybe you've heard about there's a new ceiling and there's a new floor when it comes to individuals, their charitable giving, and the tax treatment. Okay, first of all, the ceiling. The highest tax bracket in the United States is 37%. Under the new law, folks in that bracket can only deduct from their taxes as if they're in the 35% bracket. All right. And our school's research shows that that could reduce charitable giving annually by $2 billion to $8 billion a year. They have a complex economic modeling that they use and have used for many, many years. Folks are statisticians, data experts, very reliable. But now, here's what that doesn't mean. So, the most recent Giving USA showed that there was nearly $600 billion in charitable giving. Let's just use $600 billion to keep the number simple. This doesn't mean that because of this new law that we would see giving go down by $8 billion to $592 billion. What it means is wherever charitable giving lands in 2026, there could have been $2 billion to $8 billion more than that, if not for this provision. So there is some concern, will this limit some charitable giving? Who falls into this category? Who are the people we're really talking about here? Well, if you're single, this means your income is at least $626,350. If you're married filing jointly, this means your household income is at least $751,600. These are the top 1% of income earners in the United States. All right, so takeaway number one is if you don't have the top 1% of income earners anywhere in your donor database, this provision does not affect your fundraising at all. It's a moot point. If these folks are in your donor database, wonderfully, you just need to be having a conversation with them. How is this new ceiling going to affect your charitable giving, if at all? And if they say, yeah, we're going to cut back our charitable giving a little bit because of this limit, then you need to plan for that. Others might say, yeah, it's not that big of a deal. We're going to stay where we're at or continue or maybe even increase. But it's definitely worth having that conversation with your donors. Now, that's the ceiling. What's this floor all about? When we do our taxes, we have our gross income and we massage it a little bit with this and that and the other thing, and we get our adjusted gross income. And that's what we're now working with to determine how much tax we pay in a given year. Under the new law, starting in 2026, tax forms being filed in 2027, the first 0.5% of that adjusted gross income now is not deductible. And there is a concern. People say, well, maybe that is going to limit charitable giving. Let's take a look at this. And this is now where kind of your wisdom, your lived experience comes in with your knowledge of your donors. Let's take a look at that person who is a single filer. And if they're at $200,000 AGI and their donation is smaller in that $1,000 range, okay? Or let's look at married filing jointly, $400,000 AGI, and they give up to $2,000 a year. The floor is moot. Why? They just claim the universal charitable deduction. They just claim the UCD. So if folks at these income ranges are giving relatively smaller amounts, it's not going to affect their charitable giving because of the UCD. Now, what if they're giving more? And our school's research shows these higher net worth donors, again, tend to be in the top percentage, 1% to 5% of income earners in America. They tend to give $20,000 to $30,000 a year on average to charity. Now, let's think about that. If I'm at $200,000 AGI and I cannot deduct the first $1,000 off of my taxes of my charitable giving, but I donate $20,000 a year or $30,000 a year, am I going to give less or stop giving at all just because I can't deduct the first $1,000 of that? Or think about that couple married filing jointly. If they're at that $400,000 range, if I can't deduct the first $2,000 of my charitable giving, and I'm giving $20,000 to $30,000 a year, am I going to stop giving or give less? I just have to think wisdom says probably not, right? The only way it comes into effect, quite frankly, is if their adjusted gross income is the half of 1% is $30,000. And that's the limit now through the new federal law. And that's their charitable giving is $30,000. It's going to cancel each other out. And they're going to say, I'm going to receive no tax benefit whatsoever. But that would have to be somebody at a much, much, much higher income range for that to apply to. So again, talk with your donors. The 0.5%, very likely, if we think with wisdom and our donor relationships, is not going to stop people from donating who are in those higher income levels. And if they're in the lower levels, we have the UCD. Now, a couple other things to think about. Actually, this issue with state and local taxes called SALT, state and local taxes, SALT, there's been a limit on how much people could itemize and deduct. It was at $10,000. Starting in 2026, it's going to increase to $40,000. And you might be asking yourself, Why should I even care about that when we're talking about donors and charitable giving? Here's why. Because with the limit going up to $40,000, people who pay more in state and local taxes now can deduct more of those state and local taxes, and very likely now will be more likely to itemize on their tax forms. Maybe in the past, when the limit was at $10,000, they did not itemize. Now that the limit's at $40,000, they will itemize. Why does that matter? Our school's research shows that the ability to itemize can be correlated with charitable giving. More itemizers, more itemizing, more charitable giving. There is that correlation. So that could be a good benefit for charitable giving. Ask your donors, hey, are you going to be able to take advantage of that higher SALT limit? Are you now going to itemize if you didn't before? And will that affect your thoughts on your charitable giving? Right? Again, I wouldn't make it my first point of conversation with a donor, but I would definitely work it in to my donor relationship conversations. Very similarly, business owners who own an S Corp. An S Corp. What's an S Corp? An S Corp is I've started a business, and to keep the finances simple, I just run the business's finances through my personal tax forms. All right. And there are some other limits and requirements to that. But basically, that's what I'm doing. I'm keeping the tax story simple by just running it through my personal taxes. Well, if I'm now allowed to itemize and my business taxes are going through my personal taxes, when more people itemize, that tends to be an encouragement to charitable giving. So if you have those donors who they own that S Corp, maybe now they're going to be encouraged even more to donate to charity. More itemizing can mean more charitable giving. And that's why the new SALT limit and thinking about our donors who own S Corps is important to know about. Now, speaking of businesses, the business sector still will be able to deduct up to 10% of their pre-tax profits under this new law. But under the new law, the first 1% no longer is tax deductible. And this is where the worry comes in, because average corporate giving is 1% of pre-tax profits. So is this going to cancel itself out? Businesses have been donating about 1%. Now the first 1% isn't eligible for deduction. Are they just going to stop charitable giving overall? Maybe. Some of them might, right? I will say this, though. What our school teaches is that there are 4 primary drivers explaining business charitable giving. One is government relations. Every business has to go to government for some sort of license, sometimes zoning approval, different pricing approval, all these different government relations reasons. And they use their charitable giving to say, hey, we're good neighbors. Look what we're doing with the nonprofits in the local community. Another big factor is employee relations, employee recruitment, retention, and morale, that the businesses are saying, hey, we'll match your charitable giving. Hey, we have these, days where we get to volunteer together out at a nonprofit, or on the clock, you can go volunteer 1 hour a week or some such thing, right? So for employee relations, philanthropy is part of corporate giving. Altruism, meaning they just care about their local community, or they care about a particular cause. Maybe it's associated with their product, or maybe not, but they want a community that people want to work in and live in and shop in. And so their giving is centered around that. And then, of course, outreach to customers, current customers, future customers, using philanthropy as exposure to current and potential customers. Those are the 4 main drivers of business sector charitable giving. And in that context, taxes are just a bonus on top of that. So will this provision eliminate all business charitable giving? Again, wisdom would say probably not. Can't guarantee that. But again, your business donors, be talking with them. How is this new tax policy going to affect you, if at all, when you think about your charitable giving? And are there other reasons that you are active with your charitable giving that are still predominant? And how does our nonprofit fit in? Now, one other thing to keep in mind here. When a business provides a sponsorship to a nonprofit, there are ways that they can classify that as marketing and not as a charitable gift. Marketing is still tax deductible. So if the money you're receiving from a business with a straight face, legally, ethically, with integrity, can be called marketing, the business can still take the tax deduction while providing financial resource to the nonprofit. You say, okay, Bill Stan, how do I know if it's marketing or not? Write this down. IRS section 513, subsection lowercase letter I. So it's 513, and then parentheses is a lowercase letter I. IRS Section 513, lowercase letter I, lays out the details on how a business can say that their support of a nonprofit is marketing. The marketing is still tax deductible. You might want to have that conversation with the business donors who support your nonprofit organization. So in summary, we want to be very clear about this. Taxes rarely, if ever, are the first and only reason why people donate. Okay? We know that philanthropic values, philanthropic motivations remain highly influential regardless of anybody's income level, regardless of anybody's size of donation or total donations over the course of a year. That said, taxes do matter. And for individuals, they especially matter more and more when folks have higher incomes. And that's why this whole issue of the ceiling and the floor come into play, right? We also know what's highly influential are corporate social responsibilities. And those CSR interests are not going to go away even under these new tax policies. So stay mindful of the research. Have that wisdom that is based on your donor relationships. Stay in touch with your donors and your funders. You now have time before the new law takes effect to be having these conversations. That will help you with your planning. That will help you with your fundraising. And remember, it's going to be neither a panacea nor apocalyptic. It might be different for each individual donor, each individual business, but you can still fundraise with confidence. And remember this always. Your fundraising case for support has not gone away. You still have your public service mission. You still have your programs and your services. You still have your impact. And if those were true before the new federal law went into place, they're still true after the federal law went into place. It can still be very appealing to your donors and your business funders. Now, we have these types of conversations in all of our courses at the Fundraising School, more than 24, leading to 5 different certificates. We're in 10 cities in the continental United States in person. We're also online, either virtual courses or recorded asynchronous courses that you can take more at your convenience. Now, we also have custom training where we design training just for you. And we also have quarterly webinars and these weekly podcasts and our knowledge gathered in our textbook, Achieving Excellence in Fundraising, the book now out in its 5th edition. Where do you find all of this? Well, just go online to go.iu.edu/TFRS for the Fundraising School. I'm so grateful for the producers of this podcast, the First Day podcast from the Fundraising School, the Emmy Award winner, Mike Anthony, and Jennifer Boffman, CFRM. I'm Bill Stanczykiewicz. Now you are now more fully informed on this first day from the Fundraising School.